In a world shaped by financial and technological innovation, Bitcoin emerges as an enigma. Is it a revolutionary asset or merely the latest incarnation of a speculative bubble, a digital tulip of the 21st century? The tulip mania in 17th century Holland, marked by exorbitant prices and an inevitable collapse, is frequently cited as a parallel to Bitcoin's meteoric rise. From pennies in 2009 to peaks above US 126,000 in 2025, currently trading around US 66,900 in March 2026. Both share unsettling characteristics: value peaks driven by collective enthusiasm, unrestrained speculation, and an aura of novelty that challenges traditional valuation. However, beneath this veneer of similarities, there are fundamental differences that raise the question. Is Bitcoin destined for the fleeting fate of the Dutch flowers, or does it represent a structural transformation? The comparison has some merit. Just as tulips reached absurd heights, a single bulb was worth more than a house in 1637. Bitcoin boasts an appreciation of more than 100 million% over 17 years, defying conventional logic. Both attracted speculators fueled by fear of missing out, FOMO, with derivatives and leverage amplifying the swings. Tulips, lacking any practical utility beyond aesthetics, collapsed when demand vanished. Critics like Michael Burry argue that Bitcoin's supposed lack of tangible use foreshadows a similar end. Its volatility, with drops of 50% or more in previous cycles including significant corrections in 2025, reinforces the narrative of irrational exuberance. Are we witnessing a historical replay in digital form? However, Bitcoin transcends mere financial speculation. It is underpinned by blockchain, a revolutionary technology that provides a decentralized, transparent, and immutable ledger of transactions. Unlike bubbles such as Tulip Mania or the dot-com bust, where value was purely illusory and ephemeral, Bitcoin possesses intrinsic qualities that underpin its proposition. Its supply, capped at 21 million units by algorithmic design, with decreasing issuance halving every 4 years, with the most recent in April 2024. Guarantees program scarcity amid unchecked monetary expansion. Comparable to gold, it surpasses it in divisibility, portability, and digital verifiability. Thus, the claim that its price reflects only speculative mania ignores its ability to address real issues such as financial sovereignty and protection against inflation. Unlike bubbles that collapse when euphoria fades, Bitcoin demonstrates resilience and growing adoption. Companies such as MicroStrategy, Tesla, and Block, formerly Square, maintain billion-dollar allocations of BTC in their corporate treasuries. While financial giants like BlackRock, Fidelity, JP Morgan, and others have expanded exposure through ETFs and institutional custody. The approval of spot Bitcoin ETFs in the United States in January 2024, followed by significant flows with billions in net inflows during periods of 2025. And intermittent recoveries in 2026, despite some outflows, broadened institutional access, reduced perceived risk, and increased liquidity. Countries like El Salvador since 2021, the Central African Republic, and discussions about strategic Bitcoin reserves in the United States signal acceptance at the state level. While hubs such as Dubai, Zug in Switzerland, and Singapore consolidate cryptocurrency ecosystems. This support contrasts with speculative bubbles, which rarely withstand prolonged scrutiny or gain structural backing from major players. Critics label Bitcoin a bubble due to its volatility and the supposed lack of practical utility beyond speculation. This view, however, underestimates its role as a store of value amid the erosion of fiat currencies. Since 2009, its value against the dollar has soared more than 100 million%, outperforming any traditional asset.
In Argentina, Turkey, Venezuela, and Nigeria, Bitcoin already serves as a banking alternative.
Con VIX hay céntimos sin tasa. Inflation puede comprar sin bolívares.
Unlike the dot-com companies, which failed on empty promises, Bitcoin is based on a network that has operated for 17 years without base-level protocol failures. Its durability through crises, including monetary tightening in 2022 and corrections in 2025, points to solid value rather than mere hype. Bitcoin's dramatic cycles of expansion and contraction, though impressive, signal not an inevitable collapse, but the maturation of a developing market. After each burst, prices stabilize above previous lows, from US $3,200 in 2018 to US $20,000 in 2022, and lows above US $60,000 in recent corrections, revealing a growing support base. This pattern, more fractal than bubble-like, suggests progressive adoption. Volatility, although still significant, has decreased compared to the early years, indicating a shift from irrational exuberance to a more rational valuation. Yes, speculation permeates Bitcoin, with derivatives, leverage, and peaks of FOMO. However, this accompanies disruptive innovations, such as railroads in the 19th century or the internet in the 1990s. Confusing it with a bubble without substance is misguided, having survived countless obituaries.
Bitcoin maintains a market capitalization of around US $1.36 trillion in March 2026.
Unlike tulips, which had no residual value, it retains functionality and demand even in crises. Its correlation with the S&P 500, SPX, adds layers to the analysis, distancing Bitcoin from the image of an isolated bubble. Since 2020, it has shown positive correlation, often between 0.4 and 0.7 with recent variations, reflecting its perception as a risk asset by institutional investors, similar to technology stocks. When the SPX rises amid abundant liquidity, BTC tends to follow. When there is monetary tightening or geopolitical shocks, both retreat.
This synchronicity challenges the non-correlated hedge narrative but does not reduce it to a bubble. It simply links it to macroeconomic dynamics.
Bitcoin echoes the superficial traits of Tulip Mania, but its technology, institutional adoption, and role as a store of value elevate it to a rooted innovation. Its dance with the SPX signals maturity, not collapse. In March 2026, it stands out as a consolidated emerging asset, not a passing bubble.